It's really striking when you come to think about it. For most of the decade before the pandemic, rates were pinned at zero or even negative in the Eurozone. One big difference from the pre-pandemic period is yields are at attractive levels, both in absolute terms and relative to the prospects for even sticky inflation. And in the context of a global economy that's held in and a U.S. economy that's over-delivered in terms of resilience.
We have to go back to comparisons well before the GFC to see the kind of yields that we are seeing right now in core markets.
But on a going forward basis, we do expect to see some more differentiation. The U.S. being more resilient in terms of activity, maybe with somewhat stickier inflation. European economies slowing more, transmission mechanism for policy operating differently. And those have consequences not just for rates markets, but also in credit and in currencies.
And I look at it, just across the industry. People left core bonds, whether you're talking about US-focused strategies or global strategies, because coming out of the global financial crisis, yields got real low. And then to your point, Rich, not only are yields attractive, we believe yields are going to be a good predictor of longer-term fixed income returns. So when we look at value within good old-fashioned core and core plus bond strategies, they look good versus cash, and they look pretty good versus public equities on a risk-adjusted basis.
I think when investors think about core, they try to utilize it for essentially a couple of reasons. One is getting high quality yield in a more kind of a volatility adjusted manner, and on that measure, so you have essentially an environment where you're getting equity like return possibilities with a volatility that is 1/3 or 1/4.
A fraction of the volatility, yeah.
And then on I think the active part as well, right? Using the breadth of resources, using the opportunities that Rich also talked about, allows us to kind of take advantage of, or at least focus on some of those non-US opportunities as well in the US core context, again in a small size, not deviating from the true intent of the strategy, but helping utilize those to create excess return.
In terms of the decision-making frameworks, a lot of what we're doing is what we've been doing at PIMCO for several decades. We have resources around the globe covering every sector of that market. So in some sense, it's really as simple as leveraging the great ideas across the platform, consistent with our top-down themes.
I think one thing I've noticed in my time here is how oftentimes what starts as a macro conversation naturally moves into a sectoral conversation. So it's not just top-line GDP, it's policies, Washington, regulation of financial institutions creates sectoral winners and losers. And probably we're seeing more of that in the current US macro environment than we've seen in a very long time.
I think now we have a lot of tight interactions both within the team, looking at ideas that are relevant to the total return strategy itself. So I haven't been as excited in a long time to work with you on this strategy and to take advantage of what looks like, again, not only an attractive world in terms of starting yields, but that type of volatility across markets that typically is consistent with pretty good alpha generation as well.
Yeah, working with Dan over the last 18 months has been incredibly kind of rewarding as well. Dan brings a unique perspective with having run income for over 15 years.
To join the core team, core is in the firm's DNA, and it's a strategy that's critically important to us. And it's critically important to us because it's critically important to our clients.
And then, as you also alluded to, the value proposition has increased immensely given the backup in yields, given the yields that we are currently seeing that we have not seen in well over 17, 18 years. So the value proposition plus the excitement around the team is something that I'm quite excited about on a go-forward basis.